Gave up managing billions to become a better investor. Episode 41, Earnings Season, Part 2. Hello, yes, it is still the early stages of the earnings season. Quarter 3, 2023, exciting though, and already lots of interesting numbers out. We'll come and talk about those in a couple of minutes, but what else have we had going on? Well, I guess markets have been okay, although bond yields continue to back up, and that's, as I speak, impacting markets a little bit. But overall, as I talked about in my last podcast, returns have actually been all right, perhaps better than certain people would have thought from a kind of a geopolitical or general investment area perspective. I guess there are many reasons for that, but I do also note that a certain diversification of investment portfolios is always important, as well as active management. You know, my always mentioned concept on these podcasts and related. Certainly notable to see gold and gold-facing assets doing well. No surprise to see oil and gas prices higher, given that geopolitical backdrop that has been apparent for the last couple of weeks. But also, I guess, you know, the importance really of not just having that classic 60-40 neutral sort of fixed kind of portfolio. It clearly is an evolving, shifting, changing world, but that I think is what makes the 2020s interesting and not boring. But you've heard me talk about this on other podcasts already. So for me, just a continuing identification of that, if you like. For management surveys out today, I saw, and some of the headlines I've seen still fits very much in the role that investors are, or at least people who help fill out the fund management survey, are giving a sort of a cautious view towards the future. But I think that will improve as quarter 4 of the year, post the quarter 3 corporate earnings season numbers over upcoming weeks kind of push through, and as we move a bit closer to Christmas and the like, I kind of feel that as if optimism will end the year at a higher level than it is at the moment. We shall see on that front, but that's my instinct in any case. And that's why it's an active, opportunistic market. And that's why earnings season is so important. You've got to keep your views clearly, importantly, on geopolitical and macro matters. That's always a must for any investor. You've also got to, of course, be doing lots of earnings season bottom-up analysis. But, you know, we've talked about that again before. But my feeling is generally that there are opportunities out there. You just got to keep on working for them. That's all. And on that front, let's go back, have a quick few minutes on the recent corporate earnings season, early corporate earnings season updates beyond what I talked about on my last podcast. Since then, of course, we've had some interesting companies out. Certainly, I would say Fastenal is, as I mentioned last time, I think a fantastic company to give you a feel for that kind of early corporate earnings season perspective. And it's interesting, isn't it? I've talked about, for me, the importance of allocations towards the facilitation, as I call it, sector. And Fastenal, I think, it's a great play. Actually, a stock that I don't personally own for myself at the moment, but one which I think is, I guess, as always, there are plenty of other opportunities out there, and there are other stocks in that space which excite me just that little bit more, a little less appreciated in their current stock prices than Fastenal already is. But I have to say, I did actually raise my good level to buy them at level for the stock from sub $50 to now $55. Very interesting conference call. Highly recommend you take a listen to it from them. Fascinating range of insights. Actually, a lot of good, not just sort of industrial and related matter insights, but actually also the importance of a certain style of management of companies, motivational drive, how a good business, a well-run business is evolving and shifting. I thought it was fascinating. I've heard elements of that from the company before, hence one of the reasons I always listen to their conference calls. But as always, and the importance of listening to conference calls and doing, it's not just did they beat or miss their corporate earnings level hopes. It's more about sort of the tone around the comments, what that means for the future, because let's face it, what isn't already factored into the current share price. That is so much more important. So really interesting set of conference calls on Fastenal, really interesting. $55 or below now for me is the level where people should think about buying some stock. Elsewhere, obviously late last week and early this week so far, we've had plenty of US financial companies come up with updates. I still have to say, and something I said 3 months ago, that if I had to buy, and I don't own any US financial stocks at the moment, I don't feel the need to. There are plenty of other different sectors, different opportunities out there to access instead of them. But if I had to buy one, I would be looking at Citigroup. And again, I was impressed with the conference call last Friday. Again, a company which is shifting and changing a little bit, and I like that. I like it when you have shift and change at a company. It's not just that something is working well, therefore we're not going to shift it and evolve it. I like it when a company is not kind of fully appreciated, or perhaps has had some issues in the past and they're trying to solve them, and that's starting to occur. That always appeals to me from a company perspective. I think Citigroup does have that angle. I have to say, though, as I said, there are other sectors, other countries, other companies which excite me more. But if I had to buy Citi, I think every time I see the stock below $50, I think to myself, the stock actually is all right value. By contrast, JP Morgan, which came up with these numbers on the same day, to me, I reran the numbers. I did actually slightly tweak up my level of where the stock would be interesting, but I think the current prevailing share price is still higher than that level. But I tell you what I did find interesting, that was their lengthy, multiple discussions about Basel III, and again, an indication that whenever you value financial sector companies, and it's, I think, a mistake a lot of people make, particularly when I think about people in the UK thinking about UK financials, you've got to factor in a higher level of risk, alternative risk concepts, different reasons for a deeper discount, if you like, than many people do. I still can't believe people are looking at banking and many financial sector names on a PE ratio. My goodness, it's almost laughable, really. But hey, I see plenty of people doing it, and good luck to them is all I say. This week in the sort of broad US financial space, obviously a bunch of other news. Bank of America, not a stock that I particularly look at intensely. I say ironically, I look probably more at the fund management survey from the Bank of America than I do look at the company's stock. I did see that Goldman Sachs had the numbers out today. A company I've had a reasonable amount of contact with over the years. As an investor, though, not a company which I'm particularly excited by. And hey, I'm glad to see that the CEO has decided that the life of going to the music circuit and the like is perhaps not quite as high a priority as a full focus on the excellence or not of Goldman Sachs in the future. So there you go. Not surprised to see Goldman Sachs. When I last looked earlier today, the share was slightly down on the day, and I think I'm happily leave that one to the experts, as they say. Elsewhere, I tell you what has been interesting over the last couple of days, including some numbers out today. We had another couple of good updates from Novo Nordisk. I'm fortunate I don't need to use any of their products, but obviously a company which we'll talk about a bit more at length in a few weeks' time when they come up with their formal numbers. But as I talked about already, a company which I have taken profits on a couple of times already, but I still have a shareholding. And it is now Europe's largest market cap company, which is quite amazing. When I think about first coming in contact with Novo Nordisk, oh my goodness, it must be 20 plus years ago, actually more than that, maybe even 25 years ago. And what a remarkable evolution that company has had. Obviously, for diabetes and related matters, an absolutely essential company for many, many years. Great product, great international orientation. But obviously, some of the more recent, further deeper shifts by the company's range of products has got the stock market very excited, which is great for them. Great, congratulations on their great progress. I'm looking forward to the early November numbers, though, because I'm wondering whether everything is fully factored. I'm wondering whether I should actually take a few more profits on the shares. I'd probably wait. Generally wise to wait now when you're sort of a couple of weeks or so away from numbers, just to wait for the numbers and kind of roll from there. But certainly my feeling is gut feel when I see a price in the now split share of over 700 DKK, I think to myself maybe time to be losing a few more and look elsewhere. But still a great company, sadly for many reasons. It's interesting actually. Scandinavia is a great area for finding some good companies, but one which actually has had a bit of a rough run recently is Ericsson, and it's one which I have looked at. And it's funny, Ericsson, it's a company which anyone of my age or so will remember, obviously, for their mobile phones, a bit like Nokia. But of course, that's not the focus of the business anymore. In fact, not quite as extremely as Nokia, who obviously famously Nokia phones, as you'll remember them from 20 odd years ago, and now owned by a Chinese company. But hey, there you go. Ericsson, obviously, though, always had sort of a more split allocation. It wasn't quite as sole mobile phones focused. But it is kind of interesting. I still think it's still a super relevant business when we think about 5G, 6G allocations and related, which clearly are going to be apparent across particularly the developed world over the next 10 years in terms of growth potential. And as you move from 3G into 4G and progressively 5G and more in all other developing parts of the world, still very exciting. And Ericsson got a great theoretical position. It's just, as shown by today's results, a little bit of caution about 2024, but we're at that 50 SEK price, which for me is interesting, and it's a company I'm continuing to think about. I have to say, it's one which I wonder whether there are too many haters or too many people forgotten about the company looking elsewhere. I think what I've really got to do is kind of compare and contrast with some of the broader tech names which are going to be reporting over the next couple of weeks to kind of get a feel for, well, where do I want to be? Do I want to kind of sell out of more of my Alphabet shares if they ever hit $150 and put them into Ericsson at 50 SEK or something like that? Something to think about. I tell you a company which also came out today, which is getting a little bit close to my level of interest, and that's Johnson and Johnson, a company which I do think below $150 always is worth it, certainly for a more, I'm going to say, kind of total return-centered investor, somebody who's thinking about a bit of dividend, but also medium-term scope, well-run company, and related. And J&J, it's a good company. I haven't owned the shares for many, many years. Maybe on a personal account, never. Certainly institutionally, I've held them before, back in the day. But for me, anything below $150, it's interesting for a total return investor, but it's a bit like Ericsson. There's a lot of the rough peers coming out with numbers over the next couple of weeks. And I kind of feel as if if the shares when I last looked about $150, $54, there's no need for me to even be really thinking about it intensely at the moment. But my feeling is, even if they do fall below $150 over the next few days or something, I want to see what some other companies in the sector are doing and saying, and whether some of my other ideas out there. For example, later this week, we've got thoughts from Roche, a company I think is probably a bit more compelling than something like a J&J at this moment in time. But with something which is going to give a total return investor even an akin kind of return scope. So yeah, lots of interesting stuff going on, lots of things I'm thinking about, nothing that I'm really exacting at the moment in terms of my investment choices. Later this week, we've got numbers from the aforementioned Roche, but also ASML. That's going to be interesting. Whitbread, which I have sold a few shares of earlier this year, but still have a good holding in. And Mondi, which I have doubled my holding, if not more, year to date at various points. So they're all coming up with comments over the next couple of days. I'll come back with some sort of bringing it all together thoughts on all of those at the weekend. But generally, earnings season is already showing me it's an active investing world, which to me is exciting. I know it's fearful. It's different certainly than the 2010s or something like that. But that's what makes the investment world exciting, frankly, and opportunistic. So lots of things to be thinking about, lots of things to be getting excited about, much more to come. And I put another podcast together this weekend with some further thoughts on the global corporate earnings season progress and anything else that's happening in the macro geopolitical or sectoral or individual stock world as relevant. Thanks for listening. Speak to you soon. Bye-bye.